Cheers, guys. I'm Chintan Shah. I'm chartered accountant from India. I'm going to take you through the IFRS 15 and AS 606 requirements in more or less summary or a concept level. We will try to include as many practical example as possible to make sure that it doesn't get bored out. So basically, IFRS 15 is a five-step revenue model, and we have tried to break down our each session in this five-step model. So step 1, step 2, and step 3 are three individual sessions which are identifying a contract, identifying the performance obligation, determine transaction price. Step 4 and step 5 are one single session which will be a allocation of transaction price and recognizing the revenue as and when those get satisfied. At last, we will try to cover up some other concepts like how licensing revenue gets recorded, what are the disclosure requirement, key differences between IFRS 15 and US GAAP 606. A general disclaimer: this is only for educational purpose, knowledge sharing purpose, should not be taken as a professional advice. Please consult your expert before taking any legal or a professional real life decision. Okay, so let's start with IFRS 15. Step 1: identifying a contract with a customer. Now, if a contract wants to fall under the purview of IFRS 15, there are five conditions which a contract must satisfy to fall under IFRS 15. If any of them does not fall under the contract, there may be a legal contract, but the contract is not there under IFRS 15 and we cannot recognize revenue under IFRS 15. So point number A, it says that contract must be approved. Now standard nowhere says a contract has to be in writing. It can be a oral, it can be a email, it can be a customary business practice. As long as it is approved by both the parties and you can justify, that is a legal contract as per IFRS 15. Point number B, a contract must clearly say what are the rights and obligations of each party. So if I'm a chartered accountant, I'm providing the services, then contract must specify what services I'm gonna provide, what are my obligations, what are my rights, what are clients' obligations, what are clients' right. Point number 3, there must be a payment terms. That means a contract must specify that what is the consideration that we are going to receive for the services to be provided. It can be fixed, it can be variable, it can be fixed plus variable, it can be a non-cash consideration. We will see in step 3 and step 4 in detail while determining the transaction price. Now, step number 4 says the contract must have a commercial substance. That means the cash flow, risk, nature, timing must impact our entity's cash flow because of this transaction. Step number 5, most critical. It says that it is probable at initial recognition, mark my words, initial recognition, it is probable that entity will collect consideration for the services to be rendered. That means at initial recognition, we are assuming that customer is going to provide, he has a sound credit rating, because we are doing the accrual level accounting. So if services are provided but cash is not received, we are going to recognize either unbilled revenue or accounts receivable revenue. In that situation, if collectability is not certain, then we need to switch to a cash based accounting rather than accrual level accounting. So these are the five steps. If contract satisfies this five step, there is a legal contract plus there is a contract under IFRS 15. Now at times what happens that a customer may not have a good credit rating, but he makes some advance payment. In that situation also, even if cash is received, you cannot recognize full revenue upfront. It will sit in your contract liability or deferred revenue account in your balance sheet liability side, and once you satisfy your performance obligations or services, this revenue will get recognized. Now, when we talk about the identifying a contract, there are two more elements that we need to cover. One is a contract modification or amendment or a change request, and one is a combination of contract. Let's talk about combination of contract first. Let's start with an example and let's come back to the standard again. I'm a chartered accountant and a client came, let's say X Limited. It says we want two services from you. One is a pre-audit and then accounting. So what work needs to be done? Whenever some invoices or some voucher comes, you need to audit, approve them, and once you approve, then you need to do the accounting for the same. And they have signed two separate contract, one for pre-audit, one for accounting services. Now, combination of contract says if more than one contract are entered in or about same time period and following conditions are satisfied, or any of them are satisfied. Number one, pricing is linked to each other, or performance obligations are interdependent on each other. In such situation, or the entire deal is signed with a single commercial package objective. If this kind of conditions, if you see a presence of any of them, you have to account them as a one contract, even though you sign multiple contracts. So what will happen? I have signed $6,000 for accounting and $10,000 for audit. I have to account them as a one contract of $16,000. I need to allocate the value to accounting and audit separately. How? We will see in step 4, allocating the transaction price to each performance obligation. So this is a contract combination. The bigger aspect of step 1 is contract modification or a change request. Let's say I'm a chartered accountant. I'm providing the accounting services to my client for $12,000 for 1 year, $1,000 a month. On 7th month, customer came and say, hey, look, I want you to do my tax filing as well, and I will pay you additional $3,000. Now, IFRS 15 says whenever there is a contract amendment or change request comes, you need to account them in either of the two way. First one, if additional goods or services reflects its standalone selling price in change request or contract modification, then account them as a separate contract. So in our case, if we see $3,000 reflects the standalone selling price of tax return filing, then we need to account tax return file as a separate contract, even though legal contract may say it is an amendment to existing contract, increase scope of work. If we conclude that $3,000 is not standalone selling price, in that situation, again we have to account as if it is a continuation of an existing contract, and there are two sub methods available to recognize the revenue. First method says if remaining goods or services are different, that means my pending accounting service plus tax service, if those are different, yes, accounting is different, tax is different, then you need to account as a termination of old contract and creation of new contract, where contract value is equal to amount stated in change request plus pending amount to be recognized in original contract. So in our case, since accounting and taxation are different services, we will terminate old contract, we will create a new contract. My contract price is 6 months pending accounting, that is 6,000 plus 3,000 of tax filing. So my new contract price will be $9,000, and I have to deliver 2 work, 6 months of accounting, 1 tax return file. Let's say in the same case there is a second method available which says that if remaining goods or services are same, that means accounting and taxation, had it been same by change request, then I need to account them as a continuation of existing contract, and I need to do a true up or true down of my revenue in the current period as if they were part of original contract. So my original contract will become 12,000 plus 3,000, $15,000 now, and I need to do the cumulative true up or true down. So let's do another, again a quick summary. Contract modification, check. Additional services at standalone price, yes, separate contract, no worries. Not at standalone selling price, 2 option. Additional goods or services same or different. If it is the same, it is a part of existing contract, do the cumulative catch up, true up, true down. If it is different, terminate old contract, create a new contract. Your price is pending amount of last contract plus amount as per the change request. This is a brief about the contract, where a contract exists. There is a one small concept of domination, which says that if a customer or has a unilateral right to dominate a contract at will, then you need to assess the fifth condition of the contract, that is a collectability. For example, same case, accounting services. I have delivered the services for first 6 months. I have not issued the invoice. I have an unbilled of $6,000 in my balance sheet. If customer terminates and it contract does not give me a right to recover my unbilled, then I need to see basis my judgment whether I can carry the unbilled or not. So again, as I said, there is a rule based. You need to apply a lot of judgment whether relationship with the customer, historical practice, trend analysis, whether a contract will get terminated at convenience or not. Another theoretical kind of point which says that if either party in the contract has unilateral right to terminate the contract before work has started, then a contract does not exist under IFRS 15. Very logical. If there is a two party, let's say I'm a CA, chartered accountant, and a client, we have entered in a contract but work has not started and we terminate the contract, then contract does not exist as per IFRS 15. So guys, this is the 5-step models. First step, identifying a contract with the customer. We covered 3 aspects. What are the 5 conditions to be in a contract, what is contract modification, and what is the combination of the contract. Should you have any doubts, please let me know. I'm happy to discuss the same. We'll meet for the second step in detail, that is identifying the performance obligations. Thanks guys, cheers.